I'm Nick Grove at the Morningstar Individual Investor Conference for 2014, and I'm joined by Morningstar's Tim Murphy. Tim, why should Australian investors try to overcome their home bias and look at asset classes like global equities?
Yeah, I think there's a couple of key reasons, Nick. Firstly, the concentration in Australian equities in particularly the banking sector and to a lesser degree the mining sector. Really a lot of concentration risk, so that if something goes wrong in there, particularly in the banking sector, and you start to see a rollover in the banks, as has actually happened in the last couple of months, and that's a really negative and potentially big negative factor for Australian equities. So you go outside Australia into the global universe, a much more diverse range of opportunity sets across multiple sectors. I think the other key consideration when going global though is the currency effect, and so the Aussie dollar's tended to be negatively correlated with equity markets through time, so by taking on currency exposure offshore, whether that's US dollar or euro, whatever the case may be, generally speaking, that's been a great diversifier through time, so you're getting less volatile outcomes in your portfolios, and then depending on your view of the Aussie dollar from here, potentially a return kicker as well.
And is hedged or unhedged exposure the way to go?
We tend to encourage people to mainly take on unhedged exposure because we really think that currency exposure has those key benefits, as I said, of reducing the volatility of your portfolio. Given how pro-cyclical the Aussie dollar is, it really tends to be correlated with equity markets. So if you get a strong sell-off in markets like you saw in 2008, having offshore currency exposure is likely to protect your portfolio somewhat. And we saw that in 2008 when the Aussie dollar fell quite materially, as you may recall. So really important to have that buffer from the currency and the unhedged exposure. And I said lastly, it just depends on your view of the Aussie dollar from here. So we're talking about Aussie US at 87, 88. Many different views out there, but certainly if you think it's going down from here, then you want to be unhedged.
And just finally, Tim, what are the key global risks that investors should be cognizant of in the near term?
I think the biggest risk that you need to be cognizant of all the time, not only in the near term but the long term as well, is that none of us know exactly what's going to happen when in markets, and so you really need to build portfolios that can withstand a range of different possible outcomes. And so a key reason why we think unhedged global equities is a great thing to have in a portfolio is, as I said, it reduces volatility, it should protect capital during drawdowns when the Aussie dollar is likely to crash, and you get greater diversification and less concentration risk if something goes wrong domestically, particularly if that happens in the banking sector, because global will be much less affected than the Aussie market will be in that event.
Tim, thanks for your time today.
Thanks, Nick.
I'm Nick Grove for the Morningstar Individual Investor Conference in 2014.